Hey, welcome in. You're listening to the daily version of the Korelin Economics Report. I'm Al Korelin. Appreciate you joining me. It is Wednesday, the 14th of March. I got to tell you, I don't have a good feeling about what happened yesterday. I don't have a good feeling about what's going on today. Not a good feeling at all. This audio is being produced exclusively for my friends at Kitco. Going to focus on gold because that's what Kitco does. But boy, I'll tell you, this whole situation involves a whole lot more than gold right now. I've got a buddy of mine on the line with me right now, Simon Mihailovich. He is involved with an organization called Edisys Capital. I met Simon courtesy of Laura Stein down in the desert when we were both attending the California Resource Conference. Let me tell you, this gentleman has more knowledge about gold and economic issues in his little finger than the average guy on the street. Simon, how you doing, buddy?
Very well, thank you, Al.
What's going on right now? We've got a major downward movement in gold, which started earlier this week. We have bad news coming out in terms of, for example, the situation with the CME. Very bad news. The headlines in the United States are screamingly positive. Banks, the stress test results, on and on and on. I don't believe it. Do you? And how does this affect gold in your mind?
Well, I mean, as we were just talking before going on the air, the interesting thing is that on Friday after close of business, ISDA, the International Swaps and Derivatives Association, after months and months of delaying and saying that they weren't sure there was going to be a Greek default, essentially said there was a Greek default.
Yeah.
This is something that for over a year, maybe over almost 2 years, was considered a horrible, horrible event that was going to unleash all kinds of horrible consequences.
Right.
And here it happens on a Friday night after the close of business. Come Monday, come Tuesday, not a peep out of anybody.
Mm-hmm.
It's like nothing happened. Well, if that was such a tragedy, how is it not a tragedy?
Right.
Somebody has lost a lot of money. Somebody owes somebody a lot of money on account of this.
Yeah.
As we were just talking about, the ruling basically says now that the credit default swaps insurance on Greece will trigger. And the mainstream media is focused on a net exposure of $3 billion, which is immaterial. But in reality, there are tens of billions of dollars of transactions back and forth. Just because on the systemic basis, which is overall netted out, the exposure is net so small, it doesn't mean that somebody wasn't net long and somebody wasn't net short.
Mm-hmm.
And we have no idea who that is.
Yeah.
So I think that people in the know and people who understand the mechanics of what's going on in Europe are looking at this situation and they're seeing probably two things. One is that they're seeing that something that was posited as unthinkable and impossible and a Rubicon to be crossed has been quietly crossed without any comment from anybody in a position of authority, one way or another, essentially. And the second thing is that crossing of the Rubicon paves the way for Portugal, Spain, and Italy to fall into similar type of trouble just as quietly.
Yeah.
But as we were talking, it's about the money. Somebody is losing a lot of money, and somebody is about to lose a lot more money. So who is that? Who are these counterparties? We don't know. How much money will have to be printed in order to patch up this little spill? We don't know.
And the effect on...
And I think people have these questions.
Okay, here's my question. It strikes me that the correlation between this situation and the gold market is very, very obvious. Gold is nothing more, as you said, than a trade. Somebody needs money.
Gold has been a trade, as we've discussed in the previous segments that you and I have done, is that 80% of physical demand for the past 10 years have come from the emerging markets.
Right.
In the West, gold has been a speculative trade conducted with paper instruments.
Right.
It's something to trade. It's something to speculate on the price. It's not something one feels the need to own. That maybe is about to change. But for the moment, it has been a trade, and the players who have been in gold are financial players with leverage. So yes, if people feel that there's something going to happen or something is going on that they don't quite fully understand, financial professionals go to raise cash, take down their leverage, take down their risk.
Right.
And clearly gold is one of those quote-unquote risk-on trade assets, which is what it's been, where they would be doing it. and that may be why gold is going down. I don't think anybody is actually selling gold who owns physical gold. These are fluctuations that are driven by the traders who trade and speculate through paper.
Yeah.
So as we're sitting here, maybe these events will start getting into people's minds something different, which is maybe we need to own some of it,
right,
as opposed to speculate in it.
Exactly. I think that's a very, very good point, and I think that that's something that listeners really, really need to be aware of. Listen, you guys, Mr. Mihailovich is going to be on the weekend edition of the Korelin Economics Report. I'm telling you, what this guy has to say is something that you need to hear. Be back with you shortly.